Okay, let's begin with some questions for the market outlook from Sunday, December 18th. Three easy ones and kind of a difficult one. How do we short index futures? I remember you going through it, if I'm not mistaken. I can't find where. Well, there's the ticker, right? You enter that ticker into your system like you would any stock price, except it's futures. So when you enter in ES, you might get a menu opening saying, do you want ES the stock, ES the futures? You'll click on futures, then you'll have some choices to make about, well, which month futures do you want? You can then select June. Once you have ES on your watch list, there is a bid, there's an ask. You sell it like you'd sell it any other stock. You click on the bid, enter in your limit price, hit enter, and off it goes. Really like the barbell fixed income trade, but what about tips? Tips is a small market. The issuance is not very high in there, but let's just ignore that point for now. Could you add tips? If you do have a recession, inflation comes down very rapidly in a recession. Very rapidly. Because companies cut back very quickly and they clear inventory. So they clear it at whatever price they can get, but prices come down very rapidly. You even get slight deflation in recessions. If you do get deflation, the principal on your tips goes down, starts going down, whereas with the fixed income bond, your principal stays the same. If we don't get a recession and we continue to get inflation remains high, and we have growth that just kind of goes sideways, but no recession, and inflation stays quite high, then tips would have outperformed. The barbell trade is premised on the 1 year outperforming the equity markets for the first two, maybe 3 quarters of 2023, a recession occurring and rates being cut such that the duration on the 30-year really starts to push that higher. And if you do get this drop in inflation, tips will underperform. Curious on your thoughts on XLP during a recession versus TLT. As interest rates come down in a recession, bond prices go up. But in a recession, purchases and demand go down. XLP, the components of XLP will drop in price as well, but they will outperform the S&P 500. So let's just do a little chart like this. So if the S&P 500 is dropping like this, XLP may drop like this. You know, you'll still have a capital loss or an unrealized loss on your position on XLP, but it would not have been as bad as if you were in SPY. It will outperform during recessions, but there's no law that says, or no rule that says, oh, it'll go up in recessions. It'll outperform in recessions. So if you have to be in equities, a good safe place to be in recessions is to move into healthcare, utilities, and staples. You'll lose less. So there are some institutional investors running stock portfolios that must be invested at all times. They might run a large cap portfolio, and they have discretion in their benchmark might be the S&P 500, but they have some discretion in whether they want to underweight or overweight some sectors. They will overweight XLP in a recession because they want to outperform the market. That's a relative trade, right? On an absolute basis, I don't know that XLP on an absolute basis will return greater than zero during a recession. But during a recession, if the central bank follows suit on past recessions and cuts interest rates, TLT will have absolute return. In other words, greater than zero. All right, the ugly question here. Could you please steelman the argument in favor of 2% inflation target? It's my understanding. And I think you have a good understanding of the trade-off right here. I don't know that I can add much more, but I think in your mind you have the trade-off. And I don't know who said it at some point, but said that a sign of genius is the ability to hold two conflicting arguments in your head at the same time. And I think you've done a good job of this. Some moderate level of inflation is beneficial as it incentivizes investment, which is true. If you have a target of 0% inflation, that's a tough environment to get economic growth out of, because as soon as you start getting economic growth and inflation starts inching up, you're going to start raising rates to lower it back to zero. So you want to let some inflation show up because you don't want to stifle growth the moment it shows up, right? So yeah, you're right. It incentivizes investment. This is a bad, this is sort of one of the things we're going to use to make this argument here, is saying inflation makes debt cheaper. That is a dangerous crutch to lean on as an argument for why we should have more inflation. So we'll come back to this. Inflation seems to disproportionately negatively impact those in lower socioeconomic status, who typically have fewer real assets. And these are the same folks who spend nearly all of their income. So what we're saying here is that they have a much higher marginal propensity to consume. And it's not just the lower economic status, it's the 70th percentile all the way down to zero. Somewhere between the 30th down to zero is just simply economic necessity. They have no choice. And then from 70 downwards, they do have a choice, and they choose to spend every penny they make. So there's not much that I think we would do there. They spend nearly all of their income. Wouldn't it be beneficial for an economy? And what we're going to say is, if you had just said, wouldn't it be beneficial if those with the highest marginal propensity there, I'd bring out a very ideological argument that says no. But you're saying beneficial, let's make sure we have the modifier, for the economy. If those with the highest marginal propensity to consume also had higher purchasing power. So with this argument, you can take it to some extremes, right? If it's beneficial, if we agree that it's beneficial that those with the highest marginal propensity to consume have higher purchasing power, why not have deflation then? Because if they do have the propensity to spend every penny they make, and we have deflation, they'll still spend every penny they make. They'll just buy more stuff, and more stuff creates more employment. So you could use this line here, you could use it, well, if it's beneficial, where do you stop? It's like the argument I've heard for raising minimum wage. If we go to $15 an hour, that is good for the economy. You know, somebody will say, well, we're at 12. If we go to 15, it's good. It is better for the economy to have a minimum wage at 15 than 12. And my answer would be, well, if that is true, why stop at 15? Why not go to $50 an hour? Why not go to 100? If more is better, why would you ever stop? Because clearly that's not true, right? Clearly there'd be some point at which you would say, well, come on. So beneficial, if they had the highest marginal propensity to consume, I don't know that I would actually go down that road. But let's kind of see if we can't make an argument here. And sometimes making an argument for something requires that we make an argument against something else. And if we can make an argument against something else, we don't actually have to make the argument for something. We could just say, we will take what we have, we will take this option because the alternative is certainly something we don't want. Let me try just to get rid of all of this stuff. They're all in different layers. All right. So when we say that we're looking at 2%, 2% is the middle of a distribution, right? It's never 2%. There's always some variability in inflation. So it's always the middle of some distribution. So we always have these bands that say 1 to 3%. It's in the range of 1 to 3% because you're never actually going to get 2%. It is accepted that you're going to be out of the range some period of time. So it's never that you want 2% all the time. It's 2% over a longer period of time, whether it be a 3-year, 5-year, 10-year period. But that over that period of time, it would be 2%, which does allow for periods of growth when the economy seems to be heading there. The central bank can sit back and relax and say, it's not that bad yet. Yes, we do have inflation above the 3% target, but it's manageable. It's okay. Expectations are still anchored at the 2% level. They can let it run hot for a while if it's beneficial to the economy. If it starts to become unanchored, that's when you want to get it back down. Now, in recessions, it is going to go below 1%, maybe even deflation. But that is a healthy part of rejuvenating the economy for the next cycle. So you have these sort of things where you are going to be outside of the band at some periods of time. Now, if you set your target at 0%, and again, thinking that that is the middle of a distribution, right? Then you'd have to have a range of -1 to +1 because you will move within that range, and sometimes you'll be up here, sometimes you'll be down here outside of that range because of the variability. You don't want that. You want to try as best you can to make sure that the variability stays above 0. So 2% with a range between 3 and 1 is kind of safe to be. Anything lower, you risk deflation, and deflation can, especially with real asset pricing and investment pricing, can really take a toll if that starts to work its way into expectations. So we know that we don't want to be there. Okay, so we know we want to be somewhere above there, and enough above there such that we don't keep dipping into deflation enough times. However, if we set a target that's too high, let's say that we set it at 4% as the middle of our distribution. And here, we know we don't want to be there. The question is, how high do we want to go? And I don't know that there's any clear answer for where we want to be. To say let's go to 3%, well, isn't that just as arbitrary as 2%? So the argument, I think, rather than using numbers would be, why not just have a higher target altogether, which would allow growth to be a lot higher before central banks step in and stop it. That will all get built in to expectations. So if you're ever taken an economics course, you'll understand the concept of something called menu pricing. Menu pricing is based on, well, menus. So a restaurant decides, well, we have to print up a menu and we have to put prices on our menu. And we're not going to keep printing menus every week. So the prices that we put on this menu have to last for, well, 6 months to a year before we incur the costs of printing more menus. So they would say, well, what price should we put? Last year's price or a higher price? So if we have a target of 4%, you would say, well, okay, our input costs should roughly be up about 4%. So let's increase our prices 4% and we'll put these prices on the menu. So they become embedded in the expectation. And if they become embedded in the expectation in society, what's going to happen is the price level in society will increase by 4%, while wages in a society increase by 4%, thereby producing no increase in purchasing power. That's the equilibrium that you would get to. So no matter where you put it, you would get to that equilibrium. But there's something rather sinister about saying, let's go 4%, let's go 5%, let's go 6%, because your nominal wage is taxed. So if you have a government that's issuing debt, and you have a government agency, or it's not so much an agency, but it's outside but part of the government itself. For most people, they don't make a distinction between the central bank and the government. They think it's the same thing. But if we have something that's promoting higher and higher inflation and your wage is taxed, your nominal wage is taxed at the same rate, tax revenues for a government keeps going up while its debt does not inflate, it wouldn't take long before you'd start to lose a lot of faith in the debt issuance of that country, and investors would begin to demand higher and higher interest rates because they would see this as, okay, I see what you're doing. You're setting a higher target to deflate that debt away. And that instead of raising taxes all the time, you're going to raise your inflation target, which is a tax on everybody. So going too high risks that. So you're at that point where we all accept 2%. If we move to 3%, what are the outcomes? I don't know. Maybe things would be okay, but maybe there'd be a loss of confidence, a significant loss of confidence, such that all organizations everywhere have this bump up in their cost of capital, a significant bump up in the cost of capital, because everything is priced off the Treasury par curve. And if we think the government is doing nothing but deflating its debt, that par curve will shift upwards at every tenor, which means that every other AAA, AA, A, triple B, all other forms of capital will be priced higher. And of course, equities at the very top, it'll be priced higher, and the cost of capital simply just moves up. So 2% does allow for growth without a loss of confidence. 3% allows for more growth with the potential for the beginning of a loss of confidence, especially around the world. So that's about the best I can say, is you don't want it to be lower. And if you go higher, there is a Pandora's box of chaos that you could unleash. And then it would be hard to then bring it back down because you've lost credibility. So it's one of those things you've got to be very, very careful about doing. You've got to go to those global meetings where every central banker shows up, and then they've got to have discussions about coordinating it around the globe. They've got to put it out there for discussion. They've got to telegraph that years in advance so that it starts the process, and it would be great if Congress then mandated it instead of the central bank moving it, because then they could just say, okay, we'll manage the law that we've been given, and if something is bad, they can always just blame Congress. I don't know if you can actually steel man the argument more than just coming up with the hypothetical of saying, well, what if we did raise it? What are the possibilities that could happen? And if you can forecast those possibilities, you could then at least have some PR campaign to manage the transition to that over time without it causing all of those things. But just to snap your fingers and change it because inflation isn't behaving the way you want is admitting blatantly, we can't figure this out, we can't get it down. Chances are this stuff never worked all along to begin with. And there's a lot of thinking that the great deflation that we saw from the 1980s to 2010 or 2005, all the way through the 90s, that the great deflation we saw had almost nothing to do with central banks. And I've made this argument before that we think that Paul Volcker, we give Paul Volcker a lot of credit for crushing inflation in the early 80s, but maybe it wasn't, because a lot of things happened in the early 80s. Bank laws changed in terms of how much you could pay on deposits. Supply side economics started to be instituted under Reagan. You had the lifting of investment into venture capital funds from pension funds lifted so that they could begin to invest in other forms of assets, which created a bunch of innovation. And you had the beginning of the outsourcing of textiles, of steel mills, of all of that to other parts of the world. China coming into the World Trade Organization really started to lower costs as well, so that it really was the capitalist system let loose, unleashed, unregulated, removing a lot of regulation that really drove costs down, and that the central bank just happened to be doing what they were doing at the same time. I've made that argument before, that what if it wasn't the central bank that did it at all? And what if it wasn't the central bank that caused the great deflation? And if that's the case, maybe the central bank can't do anything about this whatsoever, and it really just requires a capitalist solution to solve. There is an old saying that the best cure for high prices is high prices, because that will then induce companies to innovate around those high costs, as opposed to crushing investment by raising interest rates. So we could, go even further here with inflation and say, listen, there is an argument that the central bank can't affect inflation whatsoever, so who cares what the target is? The target will be what capitalism determines that it should be by its very limitations, that the best thing that can be done is to remove as many impediments to capitalism as possible, and cut regulation as much as possible, and encourage investment as much as possible. Investment in innovation, investment in R&D, all of those things would probably be a lot better than raising interest rates. So you want to fix inflation? Why not have an R&D tax credit that says, okay, any R&D going into incremental innovation or new innovation for the next 18 months gets twice the write-off it normally would. You'd have companies rushing to take advantage of that tax credit. And there would be your innovation. You wouldn't have to touch the interest rate. I told you it's a brutal question. It's a big question. There's no easy answer for this question at all. I don't know. Maybe that gets you thinking about some other things, but I don't have a solid answer other than, we're at an equilibrium in terms of expectations with 2%, and we know this devil. And I prefer the devil I know to the devil I don't. I don't know what 3% would do. There's a good enough argument there, I think. Okay, can I buy puts instead if the market rallies? Yes, you can. And while I'm drawing on the screen here, somebody twice had mentioned, can I change my cursor size so that you can see it? There's not a lot I can do with Sketchbook here, but in ScreenFlow, when I capture it, I can make it really big. It's just that when I hover over a word, it would then hide the word. But when I'm reading something, I'll try to make a tick like this so that you know where I am on the screen. What are your most memorable trades, good and bad, and how they helped you grow? So I'm not sure what you mean here. If you mean market value portfolio, then the bad ones did not help me grow. If you mean grow as an individual, the best ones, the best good ones, were the ones where I had done my own research on it, my own thinking, and I came to a conclusion that was very different than the crowd. So it was a contrarian play, and I said, no, I don't agree with everybody else. And that the trade eventually worked out in my favor. Those were the ones I felt, even if I didn't make a lot of money on them, you feel really good about outsmarting the crowd, about outthinking the crowd and saying the crowd is wrong on this one and I'm right. It feels really good. The trades with the crowd, so something like momentum, which I've done momentum trading before. It's not difficult to set up a momentum trading strategy. All you're doing is trading with the crowd. You can be proud of the strategy that you develop to identify momentum, but you're really just surfing with the rest of the crowd. So it doesn't feel as good trading with the crowd as it does trading against the crowd and being right. This is a great feeling. This is a great feeling when you make money. This is a great feeling no matter how much you make because you played a game that was different. The bad trades that helped you grow were the ones where you learned something. And usually my bad trades were ones where I didn't do the thinking, where I heard somebody say, hey, XYZ is really good, and it gives a list of 3 or 4 points about XYZ, and I go, oh, XYZ, eh? Well, they should know. I'll go ahead and I'll buy some XYZ. And it doesn't work out. Well, I don't know why it's not working out anymore, and it doesn't work out. It continues to not work out. Well, I got a cut, only to watch it do this later on. Well, I didn't know what the trade was, so when it was pulling back, I couldn't tell, well, is that XYZ? Is it the sector? Is it the market? What is causing the pullback? Is it a technical issue? Is it something fundamental with the stock? So you learn over time, don't outsource your thinking. If somebody says XYZ is good, you make a note, XYZ. Okay, well, I'm going to look that up tonight. I'm going to spend an hour looking at this thing, and I'll see if it fits the profile of what I like. The ones that didn't help me grow were trades where you lose money, but you learn nothing, only because circumstances just worked against you. So you took a trade on something and you wake up in the morning and it's just a mess. And you find out overnight that some organization did something and it was like, wow, how could anybody ever know that? So exogenous events that just messed up your trade, but not the whole market, but just killed you. Well, there's nothing to learn there because you could not have forecasted something like that. So it's like, well, those are empty, hollow lessons. They're just losses. In your video, you mentioned you're bullish on REITs and home builders, apartment REITs. Yes, because they are not building new inventory. And it's important that we say that. They're not building new inventory, which means they're not building spec homes, which many of the home builders are saying they're no longer building spec homes. They're just building homes for a sale. So they're not building new inventory. They're still building new homes, but not building new inventory. And if mortgage rates drop in a few quarters, raising demand will confront these low inventories. That is the thesis, yes. If in the near future we expect demand to remain low due to high mortgage rates, well, if demand is low due to high mortgage rates, where are they going to go, right? They're going to stay in their apartment. And if we expect raising unemployment to potentially push some distressed owners to sell at a discount, well, that's this is something we have to unpack first. Would we see this? And I'm sure there's some distressed sellers out there, but would we see it to an extent that it would cause a increase in supply that would push down pricing? When we look at the New York Fed's Consumer Credit Report, and we look at mortgages specifically, you look at the average credit score at origination, much, much higher than it was in 2006, 2007, 2008. If we look at the amount of home equity in the home now versus then, significantly higher as well. Housing prices in 2007, 2008, a 10% drop would have wiped out the last 3 years of home buyers, and they would have been underwater on their equity, and that would have caused a cascade of house selling along with all of the overbuilding that was going on. Here, now, to cause that kind of cascade selling, you'd need a 30 to 40% drop in prices to cause the same kind of distress. With an undersupplied market, I just don't see it. I don't see it at all. I've got a low probability that rising unemployment would cause this kind of thing. Decrease in prices for existing homes hurting your REIT position. Well, it still wouldn't hurt my REIT position in the near future. Again, you have an undersupply, so I don't think it would hurt the REIT position, and it would take some doing to lower house prices to that extent. Now, a recession, if we get a recession, here's what's going to happen, is REITs are going to sell off, because office REITs are going to sell off, retail REITs are going to sell off, some industrial REITs will sell off as well, because they're all tied to economic growth. And apartment REITs will sell off in sympathy, and that's the mistake. So in recessions, when REITs sell off, the reason they tend to outperform on the recovery is because they get thrown out for no reason. They get thrown out only because of the fear that they're going to lose their rental income, but good REITs rarely do. Good REITs rarely do, so they end up being so at such a discount to their fair value that they end up having these great rebounds, which shows this great outperformance in the recovery, only because they got thrown out for no good reason. So in a recession, I would definitely be buying more. During this week's Q&A, can you please talk about what this recent Bank of Japan news means for everything? Will this possibly contribute to a rebound in U.S. inflation due to weakening of the USD? And it seems that it has the large effect of increasing yields in the long end of the curve. That's what it did today. Is this just because BOJ is selling their treasuries to get money to intervene in their own bond market? No, I don't think so. Is this bearish for the TLT trade over 2023? No. You have to sort of determine whether this is an event or this is a trend. Is there more to come, or is this an event? What the big shock is, when I was watching it last night and I just saw it drop a little after 10 o'clock and everything just dropped, because my charts are up on a computer behind me for the E-mini S&P and the Canadian and the peso, and I just saw them just move. So the first thing is, what happened? You never jump in. What happened? And what they did was they just changed their policy on yield curve control. So they had 0% on the 10-year, and they would allow it to move within a range of 0.25 to negative 0.25. Well, they changed that to 50 basis points, so it can go as high as 0.5 to negative 0.5. Well, it's easier to defend 0.5 than 0.25, so that's why I don't think that the selling was due to that. But the Japanese yen is a big funding currency because it has very, really low rates, so you borrow in yen and you invest in other currencies. The biggest currencies that should have been hit would have been the New Zealand dollar and the Aussie dollar, because they're right in that neighborhood. But everything was hit at that time because there wasn't a lot of, it just happened very quickly. It was unexpected. So it's going to dislocate a lot of things. So if you have a carry trade financed with yen, the first thing you have to ask when the yen strengthens that much is like, this is a problem for my carry trade. Because the yen is increasing in value. When I sell this foreign asset, I'm not going to have enough to buy back all the yen I need to pay back my short-term loan. So the unwinding of the carry trade, or at least the weak hands, will unwind their carry trade, which forces them to sell another currency and buy the yen to pay back whatever yen debt they had, which that's why it continued to push the yen further. Because it came out of nowhere, the question is, well, is this a one thing or is this many things? Is this the beginning of something more? And if it's the beginning of something more, if this is a trend, I better get in on it. Because they just widened the band on the 10-year. I looked at that and I said, I think this right now is an event. They're going to, if it is the beginning of something, it's not as if they're going to do something in 3 more days and then something again in 4 more days. This is going to be something that will happen over a 3, 4, 5-year horizon. So they did this, and now they're going to hang out here until the market finds its equilibrium here. And then maybe in 6 months or 7 months, they might make another tiny little step. So since it was an event, I bought futures overnight. I bought the June futures overnight. I also bought more Mexican peso because it took a dump. And I bought some Canadian, which I didn't want to anymore, but I did buy some Canadian at the 137 and ended the day at 136.10, which was nice. And I didn't hold my ES for very long. By the time the market opened, it had appreciated to pretty much all it was going to do that day. I think it ended at 38.86. I was out at 38.81. I got in at 38.45. So it wasn't bad. It wasn't a bad night. I didn't load up on it because I said, this just doesn't seem right. It seems like an event. What fallout is it going to have? I don't know. It's just a matter of time to see who got hurt on the carry trade, who got hurt the most, because I think after an hour after the announcement, the yen had moved 300 and some odd pips, but by the end of the day, it was in the 400s, 450, almost 500 pip move on the yen, which means that carry trade was being unwound during the day because there was buying of the yen all day long today. So who knows what that's going to or what that has done. We're going to have to wait and see. I tried to buy the 30-year. I had a bid out at 128.06. On the 30-year, the ZB, again, this is the June ZB, not the March ZB. I was trying to buy the June ZB, and I never got it. It showed the print for 128.06 as my bid, but I never got it, and that was it. But I did, TLT opened up much lower today. So I looked at the calls and the puts. I didn't like the price on the puts, so I bought more calls at 110. At 110 for January 24, and those I paid 710 for. I think I didn't buy many. I got 35 of those. No, sorry, 40. I had 35 hit, but by the end of the day, the other 5 cleaned out as well, or during the course of the day. So I had 40 more. I didn't like the put price. When you're going out as far as January 24, the calls and puts will not be centered around the price today. They'll be centered around the forward price, and because interest rates are so high, there's not a lot of value in the puts. I would need to see TLT suffer another day or two. If I see TLT get to 100, then I'll sell my puts. But I feel fairly confident that with these kind of shocks, if the market takes this kind of shock a little bit further. These are the kind of shocks that push low growth into no growth. And once you get to no growth, you might get to negative growth. You get to negative growth, that has a cascading effect. You get a quarter of layoffs and negative job growth, and it's clear that we're in a recession, which tips another country in a recession. Then you get lower rates. The TLT trade, I think, is still something that I'm very bullish on. Keep in mind, the TLT trade is a recession trade, right? It's not a lowering interest rate trade. It's a recession trade, and in a recession, the Fed will lower rates. I'm not betting that the Fed will lower rates. I'm betting that there'll be a recession, and then the Fed will lower rates because of it. Let's see, an interesting question. Hope you don't mind. What do you think about market movement versus your own decision? Specifically, when the market is moving to the wrong direction, like bear market rallies. Well, they're uncomfortable, right? Especially when they keep going against all odds. The one in the summer was extremely frustrating. Central banker after central banker kept saying, we're going higher, we're not cutting rates, and the market just kept saying, I don't believe you. 4,100, 4,150, 42, 4250. That was frustrating. It makes you question your own judgment. You're looking at it going, am I that wrong? I can't be that wrong. And finally Powell came up. I'm wondering what caused these overshoot moves. I have money with a money manager, and I have better insight now into what causes these kind of moves based on the activity I see within my own account. So I have visibility into exactly what I'm holding. So I have different equity allocations with different types of managers, and I can see what I'm holding. And I can see them buying stuff and then several weeks later selling it at a loss just to move into something else. And I'm thinking, why are you selling these things at a loss? Like, why are you doing this? And it's because they're not trying to do better than 0%. They're just trying to do better than the benchmark, or whatever their benchmark happens to be. That's all they want to do, is do better than their benchmark. So if the market is going up, they have no choice but to do the same thing. They have no choice but to buy into these rallies because they must do better than their benchmark. It's not a matter of I'm going to take a position against the market, and in 2 or 3 quarters, I'm really, really going to do well. Every quarter, they've got to say to their shareholders, this we have done. So, in discussing it, it's like, because you're chasing the bogey all the time, you can't take a position where you say, look, I'm willing to underperform for 1 or 2 quarters to massively outperform over the next 6 or 7 quarters in managed money. That is just as bad as being wrong, because some investors won't take 2 or 3 quarters of underperformance for 8 or 9 quarters of outperformance. They want outperformance every quarter. Probably a big thing of these overshoot moves is the market keeps going up. You have no choice but to jump on board. Would it be emotion? No, I don't think so. Overreaction to some positive news? No, I think I explained it. For example, Bank of Japan increased their policy rate by 25. Careful. They increased their range for the 10-year. In other words, they just changed its yield curve control. They just changed their policy on yield curve control. Currency market had a big reflection of that because of the unknown. Now, had the Bank of Japan telegraphed this well in advance, none of this would have happened. None of this would have happened. But nobody thought they would do anything, and then suddenly, boom, it's done. And when something is done that quickly with no notice for no reason, you have to start asking, what's going on? What are they afraid of? What are they responding to? Because it doesn't look well planned out. It looks like it was an emergency move that had to happen. You start to get really worried, right? It's the lack of information that caused a whole bunch of uncertainty, which caused the big move. If you think about it, the cost to borrow is still very low for Jap yen. Can we say Jap yen? Can we use the word Jap? Let me just finish it for you. Japanese, so you don't show up on Twitter for the Japanese yen. That's true. Or another example would be the fundamental target versus bear market rally for last week. The market decided to move up 2% on Tuesday morning, right before CPI. As a retail investor, how could I build confidence when the market is saying I am wrong in day one, but eventually work in my favor? Well, I'll go back to what I said a few screens ago: is do your research, understand what your thesis is, understand what the risks to your thesis are, and when your position is moving against you, ask yourself: is it moving against me because the risks to my thesis have become real? And if it's true, either use options to hedge out very quickly or just get out of the trade. But if the move against you has nothing to do with the risk factors of your thesis, then it's something else. Then just kind of hang in there. For example, I knew before the market even opened today, because of the move in the yields, I knew the home builders would open negative today, because the 10-year yield will set the mortgage rate. And if the 10-year yield is higher, the mortgage rate will be higher. Market participants would have seen that as a negative for the home builders. Right away would have seen it as a negative without thinking it through. So I knew they'd open down. So it was an opportunity. If I thought, well, I like the home builders, here's an opportunity to do some tactical trading. Let me grab some extra shares because I think it's the wrong move. So if I didn't know anything and I saw the home builders down today, I would have said, uh-oh. What's wrong? Am I wrong? Well, that's so stupid. What am I buying home builders for in front of a recession? Dumb. And I would have sold without saying, no, this does not change my thesis. This risk event that showed up has nothing to do with the risk factors that would make me change my mind. Hence, for me, it was an event and not a trend. And you trade events, you invest in trends. Okay, first question up here. Do you maintain your own S&P earnings forecast model? Nope. If you do, what components do you include? If you don't, how would you build one? I would not. I just would not. It's way too much work. If you're going to do it bottom up, it's way too much work. If you're going to do it top down, you'd have to do it top down by sector. I don't know that you'd have the expertise to get that done. I certainly wouldn't. Some sectors like healthcare, I wouldn't. Other than using the earnings from last period with some growth rate, I really wouldn't know. It's better to use a consensus estimate, which is the consensus of a whole bunch of analysts. It's the average of all of their estimates, which is what is provided to you in the PDF for this week in earnings, page 10, table 15A. Do you believe the market can organically grow back to an all-time high? Let's just cross this out without any QE. Yes, because it always has. 70s were higher than 60s, 80s were higher than 70s, 90s were higher than 80s, noughts were higher than 90s. They will. But by 2025, I don't know. Maybe not. But will we hit new highs at some point in the future on the SPY without QE? Yeah. I have a question regarding XSP. Considering there's a wide bid-ask spread due to low volume in pre-market, right now, because it isn't that widely used in pre-market yet. Is there a certain amount of days to expiration that you would recommend for holding short calls as hedge? No. During the day, they're just as liquid, almost as liquid as SPY. They're gaining more and more liquidity. In pre-market, these strikes near the at-the-money strike are fairly liquid. Once you start going further away, they become less liquid, but if you're trading them around like between 11 and 3, that middle part of the day, the liquidity is there. So, I would use them the same way I use the SPY options is, look at the bid and the ask, find the mid price of it, set your price in the middle. You're probably getting a fair price. Before you do it, compare it to what you can get with SPY. I sold 390 calls on XSP today. And I think I got almost 80 cents more for the 390 calls on XSP than I could on SPY. So when I put them side by side, XSP had higher premiums by almost $1 overall than SPY did, and there's no early exercise. Without simply moving decimals over, how do you convert SPX to SPY to get a precise price? I've always just moved decimal places over and said it should be in and around that price. The other thing I do to get an exact price is I just look at SPY. I look at the bid and the ask and I say, aha, there it is. So I don't have to convert from SPX to SPY because SPY has a bid and an ask, and I can just look at it. But it is set up to be 1/10 of SPX. But it will have some drift error to it because of different events that happen to the components, and especially around the dividend time, the ex-dividend date versus the payment date. Remember, the index just has the components as a paper index, so it has no transaction fees associated with it at all. Whereas the SPY will have some management expense ratio, some management fee, so there is some drift that happens over time, but it generally tends to stay at SPX divided by 10. But if I want an exact price on SPY, I'll just look at SPY. What are your thoughts on Disney after its latest earnings release, replacements of its CEO, and disappointing Avatar sales? I remember correctly, you sold some puts on Disney back in July. Yeah, and those did pay off. They expired in August, out of the money, which means I kept my premiums and I never went back in. I did after the new CEO was announced, there was a spike and then a sell-off. A spike one day and then the sell-off the next day. I did a buy right, which means you buy the stock and sell the covered call right away. And then it went up. So I just took the easy profit, and it has since gone down, and I haven't touched it since. Do you think there's a lot more downside? I don't know, now that we have new information on the company. Typically, when a CEO comes in from another CEO, that CEO wants the future to look fantastic, wants to produce great results, but maybe dealing with some legacy costs that are going to show up on the income statement for the next 3-4 quarters. Legacy costs from the previous CEO. Doesn't want that. So it is not uncommon for a new CEO to come in and the very first quarterly report ends up being very bad because everything is being thrown out. Impairment charges, write-offs, everything's got to go because that CEO wants a clean record for his performance and will sometimes throw out more than is necessary so that his performance looks really great going forward because he took a whole bunch of legacy expenses and just wrote them off once and for all so they don't keep showing up. So I'd wait until the next report is out. It probably would be ugly, but then, what about the guidance, right? But I think there's just too many unknowns right now to take a position on Disney. Could you please explain dollar roll from a beginner perspective? If you have the applied series in the bottom up folder, there is agency, which is in there, and agency, I do explain the dollar roll. You think 1 month and 1 day SOFR difference could be window dressing? I looked at the 1 month as of today, it's 4.32. 1 day SOFR from New York Fed is 4.3. So, this annualized, the daily rate annualized, I don't know that there's much of a difference here. Window dressing by institutions for year end, and this is sitting in between the range of 4.25 to 4.5. So I don't know what you might be looking at, but there's nothing here. Maybe debt market is pricing in a scenario where Fed is, for unknown yet reasons, to cut rates contrary to their predictions. No, I don't think they're going to do that. I don't think that they think, let's tell the market we're going higher, but secretly we know we're going to cut. No, I don't think they're lying. I think they mean exactly what they say, that they have absolutely no intention of cutting. Because if they were lying to the market to get the market to do a certain thing but had all intentions of cutting and they did cut, their credibility would be gone. It would be like me saying to you, say that again and I'm going to slap your face. And you say it again and I don't slap your face. Well, there goes any threat from anybody who heard me say that. My threat is no longer credible. That if I need credibility, I have no choice but to slap you in the face at that point. so that the next time I say that to somebody, they know, no, this guy will hit you, right? If the Fed does pivot, I hate that word, but if they do decide to cut rates contrary to what they say for no other reason than they thought they were going to do it, but they didn't want to tell you, all credibility would be lost. And then their job would be super, super hard. I think they mean exactly what they say. So I don't see that happening. The only time I see that happening is if the economy forces their hand, where the economy's falling apart and they just have no choice, to meet the economy where it is. How rapid will these cuts be? Depends on what causes the economy to turn down. Maybe not that fast as COVID-like. Depends, if you get a very wicked exogenous event, yeah, they could cut even without a meeting. They could just cut overnight and have release a press statement saying the next day we're cutting 50 basis points. If something really, really bad happened and the market was going to open, or S&P was going to open like down 200 points, 250 points on the news, some exogenous event, yeah, they would step in. It would be fast. But if it's just, okay, January showed negative 10,000 jobs were growth on the jobs report for December, I don't think the Fed's going to blink. If the February jobs report for January showed 100,000 jobs lost, I don't think they're going to blink. If GDP growth for the first quarter is negative 0.5, negative 0.6%, I don't think they're going to blink. Not until it gets to like negative 1.5, negative 2, and the job losses are 250, 300, 350 a month for a couple of months, then I think they're going to blink. But at that point, if we get to that point on the economic data, that has a way of snowballing. And then they would probably by May or June feel that, being on hold is not enough, that they're going to have to start accommodating the deteriorating economy. But then again, it depends on how quickly that economy is deteriorating. If it's just slowly deteriorating, I don't think they're going to blink. Is there a good ETF for Canadian home builders similar to XHB? No, there is not. Canada doesn't have a robust market for home builders. I think there's one publicly traded home builder, and that's it. And I haven't looked into it, so I'm not going to recommend anything there. I pretty much stick with the U.S., but Canada does have the same problem as the U.S. I just don't know how to monetize it. I'm not big on the Canadian market, which seems odd being that I'm in Canada, but the biggest game here is the U.S. So next question here. When you sell covered calls, what kind of duration you usually pick and why? Well, when you sell, you want to sell for short periods of time, and when you buy, you want to buy long periods of time, because theta decays like this. So let's say this is 1 year. There's 6 months. There's 30 days. You get super fast decay in theta in the last 30 days. So if I sell, time is my friend, because theta will decay. So I want to sell 30, 45 day options. If I buy and I want 6-month options, I'll buy 12-month options and sell them in 6 months, because I'll get the slowest theta decay in those first 6 months versus the last 6 months. Bullish case for commodities and miners. Do you have a point of view on uranium? Nope. No, I don't. Why do you sell puts for miners now? You recently said they rallied a lot. IV percentile is low. Yes, it is. Your base case is recession Q1, Q2, which you could see miners going significantly lower. I hope so. That would be nice. Just because I have a position doesn't mean I don't mind it going lower. So when I take a position, you have position sizes. Let's say that I want $100,000 in exposure to the mining sector. I'm just giving a round number as an example. It's nothing that I'm doing. It's just a round number as an example. I would never on day one take a $100,000 position. I'd take 10. Let's get an initial position. There's 10% of my position. I can be wrong overall. So I don't have to be right. If I take a full position on day one, I pretty much got to be right. So I'll just step in. Think about it this way. If you are a farmer, before you can harvest a field of corn, you had to plant it. You had to plant it a good 4 or 5 months before you harvest it. That's all I'm doing. is I'm planting seeds because I plan to harvest something in the next couple of years. Well, what's going to grow well over the next couple of years? This is a big field, and I'm thinking, well, what seeds do I want to plant? I think miners are going to grow well over the next couple of years. Well, I'm not going to plant a whole field right now, but let's plant a couple rows. Take a 10% position, wait a little while, see what happens. Does it present you with any opportunities to step in? Now, since I took my initial position, they've all gone up. And I've also sold puts behind them along the way. So I'm not just making the amount by which they went up. I still am working the options on all of them. Not selling calls on them, but I'm selling puts. So they had pullbacks the other week. Well, let's sell more puts, and just keep doing that. If they get put to me, well, okay, maybe now I have my 20%. Maybe I have my 30%. But all the time I'm waiting, I am going to keep working the options. And that's how you slowly build that capital base, because every time they expire out of the money, I get to keep all that money. Now I have more capital that I can use. You said on numerous occasions that if you don't know you're going to buy a stock at a specific price, why not sell a put at that price instead of buying it at the market? Yeah, if you know you're going to buy a stock at a specific price, then sell a put. So let's say, this is not a good example here, what I did with GM. Let's say GM is at $40, and I say, if it pulled back to $38, I'd buy 500 shares. Well, why just say it? I could set a limit order for $38 for 500 shares and go away. If it never gets to $38, I don't make a single penny. That if I'm going to put a limit order in at $38 for 500 shares, why not sell a put at 38 and sell 5 contracts? And I'll get some money. If it doesn't make it to $38, at least I got paid to say I would do it. If it makes it to $38 and I have a limit order, I have 500 shares at $38. If it makes it to $38 and my put is exercised, I got 500 shares at $38 minus the premium for the put. I win no matter what. If it doesn't hit $38, I win because I keep the premium. If it hits $38, I win because I get it less than $38. That's when you would sell a put. If you said to yourself, hey, look, I'd buy it if it pulled back to 38, then sell a put. Make some money on it. But when I said that I bought GM at 36 is because GM did pull back to 36. I had no intention of buying GM, but when I saw it at 36 and I saw Ford at 12, I thought, okay, that's a little bit of an overreaction for what's going on in the market right now. All the automakers are having a bit of a tough time. I'm going to pick up some shares. It's a tactical position. So that is very different than saying if it got to 38, I'd buy some. It was at 36, and I made the decision that I want to buy it at 36. By the way, for the car companies, on Sunday, I'm going to spend some time on this because some really interesting stuff came out this week. And if you want to prepare for Sunday's video, earlier in the year I did a video called The Ice Age is Far From Over. ICE meaning internal combustion engine. And I laid out the case for why we're not going to move away from internal combustion as fast as the industry thinks we are. 2 days ago in the Wall Street Journal, there was a story about the Toyota CEO saying that he's part of this silent majority that thinks that this transition to EV is not going to happen anywhere near the speed that the industry is moving. That he's saying there's going to be a shortage of materials. You're already seeing it now. Not everybody can move there at the speed that they're saying. It's not going to happen. I think also 2 days ago, yesterday or 2 days ago, every year an accounting firm does an outlook of the auto industry, and it surveys a bunch of executives in the industry and asks them questions about certain things. Last year, there was a consensus among the executives that by 2030, some 60% of vehicles out there being sold will be EV. This year, that's down to 35% because they're saying the same thing. Like, everybody in the industry knows it, that it's not going to happen. Not with the supply shortages that we're hitting right now for critical battery materials. Not going to happen. Everybody can't get there. It's not going to happen. And they're all pulling back on this, which adds to this thesis that the ice age is far from over. That makes Ford and GM interesting. Not because I think they're going to 80, 90, 100 bucks. Makes it interesting because they have high implied volatility, and if you have the options course, I described something to you called an income factory. These are nice setups for income factories, because if you take GM, let's say at 36 bucks here, GM has implied volatility of about 37% compared to SPY at 20%. If you look at a straddle on 36, the straddle's about almost 9%. The premium's almost 9% of the price. So if you buy 100 shares of GM and you immediately sell the straddle and GM goes up in 31 days, because that's January expiration, you make 8.9% in 31 days. That's the beautiful thing about this. It's an income factory. If it drops, it can drop in price by 8.9% before you start losing money on the short straddle. But that means you're also buying the second 100 shares 8.9% below the $36 price. And as it moves closer to 30, it's a screaming buy. As it moves closer to 40, it's a, okay, for now, I think that's about it. And because it has that setup where at 30, I would load up. At 40, I'm not that interested. When you're in the middle of that range at 35, 36 bucks, those are great. Buy the underlying, sell the straddle strategies on it. These are income factories. So if you do the same thing for SPY, by the way, you don't get 8.9%. You get about 4.2% on the straddle. That's the difference, 4.2% versus 8.9%. That's why you got to go down to the individual names. These are going to be great income factories for the next couple of years, because they're going to trade like ICE stocks for a while, because it's going to become obvious, I think, in the next couple of quarters that the EV market is not going to transition the way everybody thought it was going to transition last year, because everybody's saying the same thing. You're not going to get this done. Prices are way too high at this point because the input costs are way, way, way too high for everybody. You're not going to get this done. All right, I'm wondering, do you know where we can find historical PE data for each sector or each company? For the sector, if you have a sector ETF, any of the X series ETFs like XLP for staples, XLY for discretionary, you can go to Sector Spider's site and pull up the fact sheet, and it'll have information for you there. For each company, just have a look at its 10Q or 10K. You can see what the earnings are. You can look at trailing earnings. For instance, DHI's trailing earnings are 1651. So every day you can calculate a PE ratio, because the price changes every day. So you can calculate that on a daily basis. Your broker, if you have interactive brokers, call up under analytical tools, Fundamental Explorer, type in the name of what you're looking at. It has a whole bunch of information for you in Fundamental Explorer. In Koifin, you can do the same thing. When you have call up a chart of something, and then you can plot any of the fundamental data, revenues for the last 10 years. It'll give you a chart of what revenue was, what cost of goods sold was. It has a whole bunch of fundamental data that you can then put in a chart. And if you want to know how to do that, Koifin has a YouTube channel with tutorial videos on how to get that done. So head over to their YouTube channel, watch a few videos. If you have a subscription to Koifin so you can get the 10 years of data, it'll do it for you. Let's see, I'm interested to know how Lennar is showing positive revenue growth above inflation, while housing economic data has been negative all year. Housing starts in particular. No, it hasn't. You can't have negative housing starts. That would be like tearing down houses. It's had negative growth, but not negative housing starts. So you might have January 1.2 million housing starts, and February was 1.15, then March is 1.1. Well, that's negative growth month over month, but you're still building homes every month. There's still homes being built every month. It's just the growth in the homes is declining, but housing starts are not negative. Would you be covering tower REITs in your sector studies? Yes, I will. I've just got to get to them, and I have an order in mind of how I want to get things done. By the way, the applied series is perpetual, right? You pay once, that's it. I was going to have an end date for it, but the end date doesn't make a lot of sense when I think about it, that your subscription ends at as a certain date. It was going to be, a 3-year subscription, but it doesn't make any sense to have an end date. So it's perpetual in that sense. So also we are putting in place the requirements to have it count as CE credits, continuing education credits. So that'll help as well. But yeah, it'll show up in there. And since it's perpetual, it's, as I go through things, sometimes the videos that I want to put up are just, I happen to be looking at something at a particular time and I think, what, this would work well in in one of these folders. So let me do a video on this now, and I put it in those particular folders, but I will get to tower REITs. They're very specialized. If not, I would love to hear your opinion on them. There was an article a while back in Barron's explaining how they could benefit greatly from 5G adoption. Yeah, I imagine they could. I imagine that they would, although it's a matter of, who would it be? The big one out there is American Tower, right? AMT is the big one out there. So if you wanted to get a jump start on that, you can get their 10K, not the Q, the K, the annual report. Read through that and then go to investor relations on AMT. There's usually an investor relations presentation. And the presentation does a whole bunch of work for you because it'll compare something like the growth in towers over the last 10 years. And it'll give you a chart so that you don't have to look through every quarterly report to find out how many towers they have. They compile a whole bunch of data for you in investor relations. So you can get a jump on that, but that's the big one. Regarding a portfolio's fixed income allocation, would it be wise to hold a position in a floating rate bond ETF for spread exposure on top of the 1-year Treasury and 20-year Treasury strategy until the Fed actually begins to lower the rate? Well, here's the problem with a floating rate bond. Its duration is very close to zero. It has no duration, which means if interest rates drop a lot, price doesn't change on a floating rate bond, but your coupon gets lower and lower and lower. So a floating rate bond is something you want to get when the Fed is raising rates, because the price of the floating rate bond won't drop. It'll stay very close to par, but your coupon quarter after quarter after quarter will increase with the 3-month rate, whatever it happens to be pegged to. But it has a duration of almost zero. It has a very, very low duration, so it's not interest rate sensitive. So floating rate bonds are great when rates are going up. Floating rate bonds suck when rates are going down. You want a fixed rate bond that has lots of duration. So no, I don't like that. Yeah. I've been researching how to create arch models in Excel on YouTube, and I'm not finding that many videos on it are methodical like the videos you provided in the past. Try StatQuest on a YouTube channel. Just try that. He's really good, and he's got a whole bunch of videos. He may have something on this. May you provide a video using Excel to create arch models to show changes in volatility over time. If you're going to use Excel without a plugin, it's multi-step to get that done, because you first have to use your data series in a time series, and then you'll generate errors, and then you have to regress those errors on a lag of those errors. Well, how many lags are you going to use? And then you have to test each of the coefficients. to see if they're significant. If they're significant, that means you can use some of the past variances to predict the next variance, and it's where you want to go from there. What are you trying to do with this particular model? Are you trying to then incorporate that into the first auto-regressive component of it, which can get complicated? Typically, there's a plugin that you would use. I forget, there's a really popular plugin for Excel for arch models. I forget what it is off the top of my head. It was years ago when I saw it. I haven't worked with this for like a long time. Go to StatQuest, see what he has. I'm confused about the dividend risks in puts. I had sold some puts on EWZ. It became in the money over time, but on the ex-dividend date, the price of the ETF dropped about $2, and my puts increased about $2, increasing the loss. Yeah, that would do it. I have the feeling that I have more loss than I had anticipated. Could you please review the puts and calls on the ex-dividend date, please? Typically, because of the way that calls and puts are priced, if you're using a call plus a put at a strike, the present value of the dividend will be in there. But it also depends on how far out you're going. Usually, when we say the present value of the dividend is in, it means at the money. You're doing an at the money synthetic where you're selling the put and buying the call. And if you do that, the present value of the dividend should be in the options. But if you're just selling a put and you're selling a put out of the money, the whole dividend isn't in every single put. You could, even if it was, and delta moved against you, whenever it paid a dividend, the price would still drop. You'd still have some delta to go, even if you initially had the premium to overcome it. So it could be that the delta move was significant on you, that it overcame any particular dividend. And you have to be careful with this when I say that the present value of the dividend is in the combination of the synthetic if it's at the money. That is if the interest rate is very close to zero. The higher the interest rate, the more that is not true. Simply because, well, I shouldn't say it's not true. It's true if you use an at the money based on a forward price of the stock and not the current price. So somebody had asked me a question on agency a while back. Let me just get rid of this top part because we don't need it, and I'll explain what I mean very quickly. Is they were looking at agency and saying, I'm trying to set up a synthetic on agency, but it's not giving me the full dividend, that somehow there was some 60, 70, 80 cents missing because agency pays 12 cents per month. So 12 months should be 144. And even at a one-year rate of 4.7%, let's say if you discount 144, you're not going to get to 50, 60 cents. Thing is, agency, let's say it was sitting at $10 at the time, and you're looking at January 24. You can't just look at the $10 strike at January 24. That's not how options are priced. The options distribution is not around the $10. It's around the forward rate. So this would be $10, 4.7%. This would be $10.47, or $10.50 would be the center of the distribution. And you'd have to have a synthetic at $10.50. And if you did a synthetic at $10.50, because that's the center of the distribution here, you would find the combination of the put and the call should give you your 12 cents, the present value of the 12 cents in your 144. You'd have to discount back at 144. You'd have to center it around a forward price, not around a current price. Now, if interest rates are close to zero, forward price is very, very close to the current price. So when you're dealing with options, even 1 month out, keep in mind when you see a stock at $10 and you're looking out 1 month and you see the $10 call and it has a delta of 0.56 and the put has a delta of 0.44, you say, shouldn't it be 0.5 because it's at the money? You have to remember that you have to move up to the forward price, and it's around the forward price that they'll have 0.5 and 0.5. right? So that's probably what you might be missing, is where was the forward price and were you doing a true synthetic? But if you were just selling a put out of the money on a stock, no, it doesn't work that way. I'm feeling that I'm over trading, and this is not the optimal strategy since I make at least one trade per day, but my horizon is at least 6 months. I make a lot more than one trade per day. I don't feel that I'm over trading. It's just there are different opportunities that arise. And you combine that with risk management. You combine that with, multiple positions where some positions are ready to harvest, where I want to take 10% off of this position, maybe add another 10% over here, maybe roll my puts down on this, roll my calls up on that. I mean, I do that. What is the ratio of trading investment horizon that you think is fair? I don't know. So here's, let me just give you an example using TLT. So I have a strategy for TLT that goes out to January of 24. I got 115 calls at 650, and I've sold today, or bought today, 110 calls at 710. While I'm looking for puts back here at a good price to finance these. I'm not sold on whether I'm going to finance these or not. Now, this is not a 100% position. This was a initial position. We had a pullback. I saw that I could add to the position at a lower price, so I added again. I'm still not at 100%. So if we have a rally in TLT that is unjustified, let's say, I'll say, you know what, that's a little bit unjustified. Let me remove this and take a quick profit and go back to what I originally had, because I expected that would drop down again. But if it sold off some more, I may say, well, let me move down to the 105s. I might buy some calls, or I might sell some puts over here. This is all the same trade. All the same trade. I just haven't hit my 100% yet. And my plan is to hold it all the way to January of 2024. So it's not buy once and forget it. It is get your initial position and let's wait and see what happens. If the market increases, okay, well, I'm making money. If the price goes down, which, oftentimes when I buy calls, I'm hoping that the price retreats first so that I can sell puts further behind the market price than I could if I did them right away. I'm hoping, because now I'm using January 24 here, so when we have TLT at 105, you have to multiply this by the cash rate, 1.4, well, what's SOFR now, 1.432, and you will get what the middle of the distribution is in January 2024. You have to multiply that by probably 395 over 365 days, because it is 31 days away from now, or 396 over 365. And then you have to center it around that distribution. So when TLT pulls back, what it has done, even though it's at 103, when I'm selling puts, the puts don't reflect the 103 price because these are January puts. The puts are going to reflect 103 multiplied by 1.0432 multiplied by 396 over 395. I have to center it. I have to center the put based on the forward price of it and not the price today. I just didn't like the premiums that I saw today. We're going into the end of the week. I don't know if this weakness is over yet, so I thought, let me add some calls and maybe I'll have a chance to add some puts. But you see, I'm not done, but I'm staying with the plan. My thesis is still in place that at some point over the year, the recession will cause a cut in rates and I'm going to want duration. TLT has duration. So, what's the last one? Have you thought about giving some private portfolio management lessons for some students? I'm really looking for a tutor because I want to be good at this and one day live with only my investment income. I have to be careful about that kind of stuff because I really cannot be seen as giving independent investment advice to any one individual. There are lines you just don't want to cross. Most people wouldn't, if a friend said, what's a good REIT to buy? And I told them what a good REIT was, it's not as if the OSC is going to come down and give me a fine. But if I'm starting to charge money for a one-on-one session where it looks like I'm trying to give advice, that's a line. That's a huge line. So you have to be very careful about crossing the line between advising versus educating. In the applied series, I am seeing more and more that it probably is worth putting a video out or developing a video on how an individual investor would develop their IPS. And an IPS really is nothing more than your business plan. If you're going to make a business out of this, you should have a business plan. A business plan just, if you are opening a store or any kind of business, a business plan says, how do I make my money? What products am I going to carry? What services am I going to offer? That kind of thing. So in the market, your business plan would be like, well, what sectors am I going to deal with? These are the products that you're going to carry. What services am I going to provide? Which means, am I going to use futures? Am I going to use options? Am I going to use Forex? Am I going to hedge? Am I not going to hedge? Am I staying in my domestic market? How much exposure do I want? Do I want market exposure and bond exposure, and then I'm going to tactically move around that? There's a lot of thinking that you would do before you even begin to start throwing your money around, much as you wouldn't just say, okay, I'm going to open up a tool and die factory. The first thing you would do is say, well, what am I going to make? What equipment do I need? What kind of employees do I need? Where can I find these employees? How much do they get paid? Are they even available in the place that I want? How much square footage? A lot of decisions have to be made. Can you line up any contracts before you open your doors? That kind of thing. It's the same with retail investing. Is yes, you can enjoy a good living out of it if you have the right amount of capital. And every business needs some capital to start with. But you need a plan. You need a plan of what you're going to do and how you're going to do it. So I think there might be some value in doing a video on that. But as far as holding private sessions, this is the kind of industry where there are lines. And, I don't want to get up to the line and say no further. I want to be way back here in the realm of education and avoid this line where I'm sort of charging money for what seems like advice. Can you please do a bottom-up analysis of mining companies in your applied series, given there's going to be a major theme in this decade? I will, and it'll either be BHP, Rio, or FCX. It'll be one of those three. Which are not American-based. On your mining and home builders, Canadian perspective on buying U.S. securities. You're suggesting selling puts, which implies a non-registered account, correct? But the distributions on these securities would face terrible tax treatment should you eventually be assigned shares. I see. With the withholding tax from another country, you can always avoid the withholding by using synthetics, so that's not an issue. I'd love to know your tax location strategy for short puts. So here's how this would work. And I'm just going to use an example. Let's say that you see a stock at $100 and you sell 90 puts. And let's say this stock pays $5 a share in dividends per year, and there's a 30% withholding, so that you'd actually only get $350. But then your government decides that this $350 is going to be taxed as ordinary income because it's not a Canadian-based dividend, which means you might have as high as a 53% tax. Yeah, that sucks. But you can always just smuggle that in. You sell the 90 puts, it drops to $85. It gets put to you at $90. So you have the stock in your account the next day at a price of $95, and it's sitting at $85. So you have a $5 loss. What you can do is you can then immediately sell this, or even before the end of, if you know it's going to be put to you. Let's do that so we can avoid all of this. With Interactive Brokers, it costs me nothing to have put to me, but you may have to pay to have it put to you. So the stock is sitting at 85 bucks. You've lost basically $5 and you got a $90 strike. Okay, well, that's easy enough to do. If it's the day that you're closing out, you're going to put an order in. Let's say that this is December and you're looking at January of 24, and this is December. You can build your strategy where you would buy a December 90 put. You would sell a January 2024 $90 put, and you would buy a January 24 $90 call. And you would enter that as one order. It would cancel off your put, and it would give you a synthetic with a $90 strike. Now you've lost $5 on the put, but if you had been assigned the shares, it would have showed you had a $90 cost basis. Well, your synthetic will show you that you have a $90 cost basis. Now you have a $5 loss, which is capital loss, which will lower your tax, the taxes that you have to pay for the year coming in. You have a synthetic, which is 2024. And the present, if this is done at the money, the present value of the dividend will be within the premiums that you get for the strike. So now everything is a capital gain. But in Canada, here's the issue you're going to have. I can see it right now is CRA is going to say, hang on a second, you don't have a capital loss here because you have effectively maintained ownership of the security by using options. Since you sold this $90 put in December, that is a capital gain that you've realized in December. So you can offset the capital loss against this capital gain, but you'll have a tax to pay in April because of this right here. However, the tax on this capital gain is going to be significantly lower than what you would lose on all of the dividends. I know that sounds like a lot, but if you want to avoid any withholding tax and any punishing tax on dividends, use synthetics for your long positions, and you can avoid all of that. Well, there's a middle part in here that I wrote over, so let's see if I can read it. On the long one-year Treasury suggestion, would you ever consider a synthetic long bond? No. I've noticed on agency and a few non-dividend payers an annualized return of 6%, assuming options would actually sell at their midpoint. I don't know what this means. I don't know what you mean by I don't know what that means. Sorry, I can't answer that. In regards to Goldman Sachs commodity report, how do you stay in the loop on these types of reports? Do you subscribe to GS email alerts or find the reports through another sources? Twitter, just looking for insights on how to find these. I don't know how you would find them on any other system because, you know, I've been asked before to keep my answers as generic as possible in case you're using other trading venues, but I can't cover every trading venue. All I can tell you is where I find it in IBKR, and then maybe you have something like that in your trading system. But on IBKR, there is a news button that I can press, and I can have general news, and there's another tab for portfolio news, and it will only feed to me the news reports that are related to anything I hold in my portfolio, and I read that 2-3 times a day. First thing I do when I get up in the morning is I go right to that. It's right on my iPad. I use IBKR Pro. I'll click on news. I'll click on just the major headlines overnight. I'll just scan through them to see if there's anything big and important. The really big important ones have red stars beside them, so they're nice and easy to spot. I see nothing there. I click on portfolio news, or just tap on portfolio news, and it's only news related to what I'm holding. That's usually where I find these things. And IBKR gives me a whole bunch of all the news feeds from everywhere. I get all the news feeds. Now, I may not get the entire story all the time because it might be from a source where you're limited to two, you know, like Wall Street Journal. If there's something in Wall Street Journal, oftentimes I can only read like 2 stories a month because I don't subscribe to Wall Street Journal. But it's in there. That's all I do is I just stay aware of what's there. I am lucky in the sense that I've had a lot of level 3 graduates from the CFA program that I offer. I shouldn't say the program, the teaching that I do for the exam. They go on to be in well-placed areas. And I do get on a regular basis emails with reports saying you might find this interesting, you might find that interesting. So I do get kind of lucky in that sense. But when I get those, I don't really share the information from those because, well, I don't have permission to share it, and it's more or less for my own personal reading. But anything I do share is I'll give you the link, is because it's widely available out there. You just have to read. You just have to know where your news feed is, and then you look at your news feed every morning and you say, is there anything here I care about? Okay, next question here. It's right up here, number 1. I saw that ES June SPY futures initial margin is around 10K, yeah, in US dollars. I want to get your thoughts on trading micro ES futures and if there is any disadvantage of doing that for those of us who have less funds available to trade futures. No, there's really no disadvantage. The bid and ask might be a little bit wider. It might not be as liquid, but it is just a smaller contract. That's all it is. It has the same characteristics in terms of the type of delivery that you get, cash settle, but it's the same thing. If you're going to the micro, you sort of have to ask yourself, well, why are you using futures as opposed to just using XSP or SPY? Why not just use options on those instead of futures? Futures do have a linear payoff, by the way. That is the nice thing about them, is if you have a low volatility environment, you don't need convexity. Convexity is great when you have a high volatility environment. But with low volatility environment, the convexity adds little value that you're either paying for or getting premium for. So why not just go with a linear function, which the futures have? Plus, you can trade these 24 hours a day, right, on Globex. If your system allows you to trade futures, it will give you access to Globex. So at 10 o'clock at night, when something funny happens in Japan, like changing their yield curve policy, and futures react really wildly and you think it's a stupid move, you can actually do something right then and there before that opportunity disappears by the time the market opens, if you just stuck with XSP and SPY. That's a nice thing about futures, is it gives you flexibility all through the night. I don't know how liquid the micros would be going into the night. And if they're not very liquid, I know that ES is extremely liquid all the time. I don't know about the micros. If you lose liquidity at night such that it isn't even worth trading it, you really have nothing more than XSP or SPY that you might want to stick with that. But there is no downside to it. It is probably less liquid than ES. That's about it. If there is no reason for you to trade futures, in other words, you don't really care about the linear relationship, you're okay with a convex relationship, you don't necessarily need the linear relationship, and you don't really care about trading outside of regular trading hours, then stick with XSP and SPY. Number 2, where's number 2 in here? Here it is, right here. Number 2, I want to understand more why you do not prefer to buy puts again at this time of SPY to rally. You said you would not sell calls. Well, volatility is low, so I don't want to sell calls. And plus, if I have more of a view towards the downside, in other words, my directional bias, because we're sort of on recession watch, my directional bias is downwards because earnings haven't adjusted down yet. And I think that will happen. I don't know how much downside we'll get on earnings, but I do think they'll adjust downwards. My bias is downwards, so I want to profit from that belief. You sell calls when your belief is that I don't see any upside, but I don't see a lot of downside. Then you'll sell calls, right? Because you think, okay, well, here's the stock price. I don't see it going much higher, and if it does go much higher, I don't think it'll go much higher than where we are now, plus the call premium. So maybe there's your break-even price. I don't see the market getting much above that. However, I don't see downside. But when you do see downside, you don't want to play the not bearish game. You want to play the bearish game, which means you want to trade in that direction. So you can buy puts or you can use futures. Futures have a linear relationship with price. Puts will have a convex relationship. And it's the same in fixed income as it is anywhere. When you expect volatility to be low, you want to reduce convexity. Sell the convexity in your portfolio because convexity is not providing you with anything and it's a bit of a drag on performance. So at low levels of volatility, if you are expecting some downside action without, if you think the market's going to suddenly crash downwards, volatility will spike, go ahead and buy those puts. But if you think it'll be just a slow realization over time that earnings are coming in, guidance is lower, and that we're just going to trickle down over the next 3 to 6 months, then get a linear relationship because volatility will continue to remain low. To get a spike, you're betting on an event. That's hard to bet on an event because events are exogenous. So the default position is to say, well, I think we're going to have a slow bleed with no event, but if an event shows up, great. My futures will do just as well as any other option would do. So that's why I'm with futures. Not only that, with the quantities that I deal with, ES is the same as 5 options on SPY, as 5 contracts. So instead of paying 5 times the contract fee, I pay 1 times the futures fee. So it is cheaper. Long explanations for the questions this week, huh? You mentioned the benefits of being long duration due to potential rate cuts if a recession does occur next year. There are 2 benefits to being long duration. Number 1 is your duration is your sensitivity to changes in rates, and I think that there's more downside to a change in rates than there is upside left. So that's the one thing that you're holding in abeyance, is I can get that exposure if it happens. The other is these yields are fairly good. The yields that you're getting paid to wait, which is pretty good. Long duration due to potential rate cuts if recession does occur. And keep in mind, if you have TLT, you have a yield on TLT, and if you want to enhance your yield on TLT, you can go $10, $15 out of the money, and you can sell calls each month for another, even if you're getting 50 cents on the calls each month, you're adding to the yield that TLT is providing. So you can do that, 50 cents each month. Don't get greedy. Just try to get a small 5% yield on TLT over the course of the year. So at $100, if you're getting 50 cents a month, and you can do that every month, that's another $6. Well, that's another 6% yield on TLT that you're getting on top of the yield that it pays. So you can use the options to enhance your dividend and minimize the risk of it being called away because, well, is it really going to go up $10 over the next month? If it does, well, that was a great return on TLT anyway, so I'll take it. But if not, I get that extra enhancement off of the options. Always use the options. Long duration due to potential rate cuts if recession does occur. Would it be possible to get this exposure via growth stocks or small cap stocks? No, it probably wouldn't, because you have to think about the price of a stock. Well, actually, let's just use the value of any asset is equal to whatever cash flow you get discounted at whatever interest rate that you get. For bonds, this cash flow is known. It's constant. So if your discount rate goes down, your valuation can only go up. That is bond math. Every bond analyst would agree with that. However, with stocks, you have to worry about your cash flows. In a recession, your cash flows will do this. They'll go downwards. So the question is the drop in cash flows a greater effect on value than the drop in the rates? And if it is, your valuation will go down. Because the cash flows for stocks are not known in advance, they're random variables, and they really depend on the state of the economy. If the economy is in recession and it turns down, then your numerator also drops as well, but your numerator won't drop for bonds. That's the power of bonds in a recession, is you can predict your cash flows with absolute certainty. What are your thoughts on inflation and interest rates going forward? Do you hold much weight on thoughts that this will be much more volatile going forward? Do you believe that we will turn to a low inflation environment? Well, technology and innovation will always drive costs down, and we live in a digital world, and more and more and more so in a digital world. And in a digital world, especially in a lot of different services that we can get online where we don't need humans anymore, you have diminishing costs to scale, not increasing costs to scale. So when we talk about economies of scale, as you get bigger, your costs tend to go down. But then there comes a point where if you get any bigger, your costs start to increase. You have increasing costs to scale. So there is some optimal size for a firm. But with technology, like just take iTunes for example. Well, how many songs can you sell? It's unlimited. So your cost per user just keep going down. That's called diminishing returns to scale. They just diminish to zero. So that is in itself deflationary. So the more digitized we become, the more automated we become, the lower the costs of getting things done. And AI is the next big revolution. It's really not here yet. Some aspects are showing up here and there. But think of AI like it's 1992 and you just heard this word called the internet. And you're thinking, well, what is that? Well, it was years. It was 15, 20 years, really. I mean, by the time you got to 2004, 2005, where you really started to see the huge power and productivity of the internet available for you. But 95, 96, 97, sure, the internet was there, but it wasn't really doing anything. The dot-com boom was the industry's way of trying to say, well, what can we do on here? Well, we can sell toys, we can sell pet food, we can sell growth, we can sell all these crazy things, and everybody rushed in, and most of that stuff never really worked out. Well, AI is like that right now, where everyone's saying, well, what can this do? So there's all of this hype around AI, and there will be that expansion of everything, then a whole bunch of that stuff will go away, but some really powerful applications will exist and survive. So going forward, I would say that deflation is probably the bigger enemy, especially in countries with aging demographics, like we have in the US, like we have in Canada, like China is starting to see, like Japan definitely has, unless these countries embrace a significantly higher level of immigration, and immigration at a younger age. There's no point in bringing in grandparents. If you're opening up your borders and bringing in nothing but grandparents, you're just making it worse. You got to bring in families. You got to bring in the 30 to 35-year-olds with 2 kids that are 5 and 6 years old. You got to bring in those. And if you don't open up to that sort of population growth, in Western societies, the birth rate is just far too low, and you have a huge retiring generation that's larger than the generation today. So the generation exiting is larger than the generation entering. Unless you fix that, you're looking at big deflationary forces in your economy. So my thoughts on inflation and interest rates going forward, if those things aren't fixed, is that you're going to go down. You're not going to stop technology and innovation. All right, you're not, throwing your shoes in the machines at this point is futile. That's not going to work. So that is one force that you have working for you. There's always a bunch of smart people saying things are too expensive over here, but my algorithm can solve that. No, my algorithm can solve that. No, my algorithm can solve that. And that's as long as you have a capitalist system that encourages innovation, and you have a capital-based system that invests in innovation like venture capital or private equity, that is a force for deflation always. If you have a government that is not willing to embrace immigration, then you're going to have deflationary forces with the combination of those two things. Probably a longer answer than you wanted, right? Would it be possible to hear your thoughts on any other asset classes, such as emerging markets or some alternative strategies, such as managed futures? Some of the alternative strategies, unless you really understand what you're getting into, are really not worth heading into. Some of them you could replicate on your own. I find that there's so much opportunity with just what's available in terms of bonds and stocks that are publicly traded. There's so much opportunity, especially if I can bring options in on it, that I really don't need to go into illiquid asset classes or asset classes that I might not fully understand or that I might not have a lot of control over. I don't feel the need to get there to get outperformance, because I can outperform. You just give me some liquid options on some stocks and I can outperform. All right, next question here. You mentioned Alcoa in the past, but not so much anymore. I see there is a higher IV for Alcoa than other miners, so it is more attractive to sell puts. What is your outlook on that particular company? Yeah, I haven't mentioned Alcoa at all. I was interested in it when it was down in the 30s a while back. I bought it, sold it in the upper 40s, only to watch it go into the 80s, and it just upset me every day. So I took it off my screen for a while because I didn't want to look at it. But yeah, sometimes you just forget about something, and I have forgotten about it. But yeah, it is interesting. They are integrated, mining, refining, all the way to, I think they even do some recycling. Can you show the set of trades you would do to remove a particular stock from a sector ETF using options? Well, I don't use options, and I wouldn't use options to get rid of it. Let's say that you want to buy an ETF and you're going to put 10K into an ETF, and one stock represents 20% of that ETF. So that means of the 10K, 2K would be represented by that one stock. If that stock is selling for $100 a share, it's the equivalent of having 20 shares of the stock inside this ETF. So simply short 20 shares of the stock, and it removes the stock from the ETF. So you'll be long 10K the ETF and short 20 shares. So your net exposure will be 8,000. If this stock goes up, well, it will go up within the ETF. The 20% will go up by the amount that the 20 shares will go up by. If it goes down, well, the ETF will go down. You've basically removed it and now only have exposure to the net 8,000 for the particular trade. Let's see. 3. When you say you want to sell puts on a significant pullback in TLT, what does it consist of? Are you looking for TLT to hit a specific price or IV level, or do you sell puts while it is on the way down? Not necessarily selling puts at one level, but at multiple prices. That's what I would do. I wouldn't look for one big hit, because I have a large call option position in TLT. So I would do it opportunistically as it dropped. I'm not looking to sell a number of contracts. That's not what I'm looking to do, and I'm not worried about the delta at all. I spent some money in buying calls. I would like to get that money back in selling puts. So I may have 100 calls, but based on how the price works out, I may be able to cover that price with only 80 puts. So I'm looking for a good opportunity. The pullback that we had this week just wasn't enough. I wasn't really that impressed with it. I want to see, if there's pressure on TLT, I want to see it at 100 or 99 or 98. Then I can I'll probably sell puts to make up these dollars. But with the small little pullbacks we've had, and it seems to find good support on the bid at those lower prices, I'm not willing to sell puts just yet, so I'll wait. But I am trying to get dollar neutral on these, not delta neutral or beta neutral or duration neutral, just dollar neutral. While the retail sales in November adjusted month-over-month changes were not good, is there any value that can be taken away from the not adjusted or non-seasonally adjusted in general? Any insight on how retail investors should interpret adjusted versus non-adjusted? Yeah, so the seasonally adjusted gives us the trend, right? Because if we don't look at the trend, what we would see is something that looks like this. With Q4 always higher in Q4. And we would say, when you look at Q1, you'd say, oh my God, there was a real drop-off in retail sales. The consumer's falling apart, but they're not, right? So that's why when you look at seasonally adjusted, you get something that is smoother like this. It smooths out those peaks by adjusting for that seasonality. So if you see retail sales doing this, it's taken seasonality out. That's a downward trend, where in fact it might be doing this, right? So you'd see, oh, it's going up, but seasonally adjusted, no, the trend is going down. However, your companies that you own report revenues in non-seasonally adjusted numbers. So you can look at the non-seasonally adjusted numbers to get an idea of how revenue is growing for your company month over month or quarter over quarter. But I would look at the non-seasonally adjusted for, if you're looking at retail sales and you're looking at, let's say, Best Buy, for example. You would look at the category that Best Buy sells in. and you would look at what November retail sales were for 2022, you might find, oh, they're higher than October. But that doesn't matter. You have to go back to November of 21 and look at what retail sales were on an unadjusted basis there, and are they higher year over year? And if they are, it's a very good bet that Best Buy will have revenues that are higher year over year as well. Is it higher year over year, greater than the CPI, greater than inflation? And it better be, because Best Buy's costs will increase with inflation, so you hope that their revenues increase by inflation. So it is a small little way that you can sort of triangulate the quarter by looking at the year-over-year increase in retail sales in the categories that they're in, and looking at the year-over-year CPI increase, and you could say, well, do I see that gross margins will be compressed because CPI rose faster than sales, right? Okay, we're almost done with the questions here. A couple more here. What do we got? With regard to the volatility and nominal risk-free benchmarks, when using CAPM or build-up method to determine your cost of equity in valuing private investments, is there a strong case to use a normalized risk-free in this economic environment? Would the spot rate still be appropriate? I wouldn't use the spot rate. I would probably find, and even when the rates were near the zero line, I still would not have used those. I would use some normalized rate that you would expect over some longer period of time. Perhaps using a 5-year yield plus a spread, maybe 100 basis points on that might be sufficient, or maybe just using the 5-year spread if you're just using your risk-free. I would use that. Or you could simply just start from a corporate yield. Let's say a investment grade, whatever, it's a private firm, probably a high yield yield. The spread plus the yield, I would probably use that because it'll reflect a 7 to 9 year yield on that. A lot of focus from regulators on corporate ESG factors in the valuation process of privately held investments, both debt and equity. My initial view is that ESG factors should already be captured in the business plan or debt agreements with companies and issuers. Well, the G would be, that's governance, right? A lot of G, especially in bond issues, are contractual. So you always want the G. The E, you have certain rules that you can't break. And then you have, so there's certain things you can't do. And there's certain things that are nice to do. I don't know about the nice to do. It depends on the company and what it is they're trying to get done. It's the S that is the real problem here, right? Is there a strong case for incorporating ESG on a standalone basis for valuation purposes? Let's just take off the G. All right, let's just agree that the G doesn't belong here. It doesn't belong with ESG. The G has always been there. The G is important. The G is just with normal business valuation. When you're an investor in any business, the first question you have is, who's looking after my money? How do I know you're looking after my money? How do I know you're doing the right thing? How do I know this isn't a scam? How do I know you're not ripping me off or making stupid decisions outside of certain boundaries? That's always been there. It's the E and the S. The S is the more controversial one. E, yeah, I think that, if it is a good business case to take care of E, and there's more and more regulation around E, you got to deal with the regulation. This is, I think if you remove the S and just went E and G, it wouldn't be controversial at all. It's the S that's the big controversy. So I don't know that there is a strong case for incorporating ESG, but a very strong case for incorporating EG. Where I think there's a case for S is where there's always been a case for S. In any system, you have a spectrum of behavior and beliefs and ideologies. And you have a range under which they are acceptable, right? And you have some people with beliefs and ideologies here that can have conversations with people over here because you're not too far apart, but you disagree. It's these people. It's if you have an organization that is going to be really way out on the wings here or really way out on the wings here, they're not going to appeal to almost anyone. They alienate the middle and they just absolutely hate the other side. It's this that's a problem, but that's always been a problem. We've never gone to the white supremacy dollar store, nor would anyone ever go to the white supremacy dollar store, right? That's where the issue happens with S's in the wings. But in this range over here, there's a lot of acceptable behavior, even though we might not always agree with everybody else. It certainly isn't a cause for getting the guns out and killing the other side, right? Last one here on this screen, we already had 2 quarters of negative growth earlier this year. Negative growth in terms of looking at it in the output method. And we have an identity, aggregate output equals aggregate income. But when we looked at it through the income method, we had positive growth with the income method, but negative growth with the output method because of fluctuations from month to month in certain key components that showed that there was some effect on GDP when realistically it was an anomaly of just the numbers that we were using. So when you combine the two, when you weight them by 0.5, we didn't have any negative growth in the first part of the year. So there was no technical recession, but let's just give it in the sense if we take aggregate output, we did have a technical. What exactly should happen next for us to officially conclude that we are in a recession? You got to see unemployment rise. You got to see, some people lose jobs. Unemployment would have to rise, and you would have to have a broad-based contraction across the economy in almost every sector. Well, that hasn't happened yet. We haven't really seen that. So when you see the consumer falling off, when you see unemployment rising, when you see job losses month after month instead of job gains, then you can say you're in a recession. But as of now, it doesn't appear to be the case. And if we are in a recession, it's been one of the most unobvious recessions that I've seen. A recession that everyone talks about that's coming, but that nobody, not a lot of people are saying, my God, this economy sucks for me right now. With unemployment so low, nobody feels like they're in a recession, right? You know, the old expression, a recession is when your neighbor loses their job. A depression is when you lose your job. Okay, a couple more questions. I know the screen is blank, but I need the screen to write on here. A couple of questions I could just take care of verbally, but one of them I want to use the screen to write. One was, how would a short futures contract affect dollar delta beta of the portfolios? I'm not sure if the delta of the futures contract would be constant. The delta would be 1. It would be the same as holding the equivalent number of underlying shares. The beta of the futures contract would be 1 because it would be the beta of the market. So it really is just the dollar value of the futures contract that you hold. For ES, for example, it's 50 times the index. So whatever the value of the index is, multiplied by 50, that is the notional value of the futures contract. What does the U.S. debt ceiling mean for markets? Nothing. It's just political circus. That's all it is. It really means nothing. And there was one comment that just said Japan screwed the TLT trade. You can say, yeah, they did, but they really didn't, because the trade is, there are 2 parts to the trade. So let's draw our timeline over here, and here we are here in December of 22, and we're going to go to January of 24, and we're buying calls, right? We're buying calls, and I've got the 115s and I've got the 110 calls. And we can look at the price of TLT, let's say it's 104, and we know that the 1-year SOFR rate is 4.32. So if we say E, multiply that by E to the 0.0432, you will get a forward price on TLT, and the options will be centered, the 0.5 deltas will be centered around the forward price, not around the current price. So the first step is, this is number 1, right? This is not the trade. This is the first leg of the trade. And let's say I paid 30 grand for all of this stuff. Whatever it comes to, let's say you paid 30 grand for all the options. If TLT doesn't get above 110 by January 24th, you stand to lose 30 grand. Well, I don't want to lose 30 grand. I want to be dollar neutral. So I'm going to look to sell puts. So if we say, well, we're sitting at, there we are, 104 right now on TLT. I'm going to look to sell puts at 100 or 95 or 90. So it is in my best interest to see TLT pull back for a period of time so that I can get my dollar neutral down here. So maybe I'll sell 30 grand worth of puts down here at 90. I want to get dollar neutral so that if it doesn't get above 110, I lose the 30, but I make the 30, I break even. That's what I'm trying to get to. So when I buy the calls and TLT starts going up, well, okay, I'm making money. It feels good. But what if it goes up and then just goes sideways for a long period of time at 109.99? Well, as time goes by, theta will start taking away any profit I have. I'll start to lose and lose and lose and lose. And even though it's 199 with 3 days left to go to expiration, I will have options that might be worth $200 at that point. So it went in the right direction, just not far enough for me to make any money. It's got to overcome the gravity of 110 by how much I paid for it. So for instance, at 115, I paid $650. By expiration, TLT has to be above 121.50 for me to start making money. Well, I want to start making money right away. I want to sell some puts. So you may say, well, when you bought the calls, why didn't you just sell the puts? But why? Why leg into the trade at that point in time? Why not buy the calls, and if TLT goes up, I start making money? But what I'd like at some point is for TLT to go down, because nothing does this. It does this. Right? Things do this over time, and then you have some event, and since it's a recession trade, you have some event, and this is what I'm hoping for at some future point in time. But I want to pull back so I can get a better put price than I would have had I bought the put and the call at the same time. I want to get a better put. Now, once I sell these puts and TLT starts going back up, I'll start, the value of these calls will start going back up, but the value of these puts will now drop. So now I'm going to really be making money because I've increased my delta. So I may have a delta up here of 0.3, and I may sell calls, puts down here, which gives me a negative delta 0.3, but since I'm selling, that gives me a positive 0.3. I now have a delta of 0.6. So I then end up making money sooner. I have three outcomes of this. The TLT ends between, let's say I get them at 95, ends between 95 and 110. I break even. I neither make nor lose. TLT is above 110. Well, because I'm dollar neutral, I start making money let's say 115. I don't start making money at 120, 150. I start making money at 115 now, because I've covered off the cost. Or TLT finishes below the $95 price, well then I'll have to buy TLT, but what a great price to buy it at with a high yield. These yields aren't going to stay high for an extended period of time without destroying the economy. They're just not. They're going to come down. So I wouldn't look at TLT as saying TLT or Japan destroyed the TLT trade. I would look at it as saying Japan gave me an opportunity to buy my puts that I wasn't going to get otherwise. So Japan gave me the opportunity to finish off the second leg of my trade. The goal in this trade is to be dollar neutral. I'm not dollar neutral right now because I bought 115s and 110s. TLT's having a little bit of trouble today. I would like to see it get down to 100. Yeah, I'm going to lose over here. Not lose, but my positions are gonna drop in value over here. But the puts are going to increase in value such that I can then use that opportunity to get duration neutral. Dollar neutral on that trade. So don't see these things as a negative. This first part, when buying the calls, that was just the first part of your trade. You have to have a plan of how you're going to get in, what the trade is that you're looking at, how you're going to leg in, when you're going to get your second leg, and then off you go. If you just look at it as I bought calls and now Japan screwed that up, you're missing the point of the other side, which is it's giving me the other thing I need, which is to get my put at a lower price. And that'll be it for today.